everybody, and it's a real pleasure to be here and also being able to speak to such a nice full room. So we thought that we'd start off actually just by giving a bit of an introduction to the company. I'm quite sure that some of you may be perhaps familiar with what we do, but many of you might not be. So we at XP Factory have two brands. We have Escape Hunts and we have Boom Battle Bars. And they're both in the leisure space, very much the experiential leisure space. So Escape Hunt is our escape rooms business. It's now the global leader in escape the room experiences. We've grown to circa 25 sites here in the UK, another sort of 22 or so in and around our franchised business internationally. It's a business which we set up back in 2018, so it's grown fairly quickly from that point. And for anybody not familiar with escape rooms, I'm sure there'll be many of you that have indeed certainly not played them and perhaps might not be familiar at all. It's a very fast-growing, quite new form of experience, a new form of leisure. And ostensibly, you come together with your team, with your group of friends, whoever it might be, 4 of you, 6 of you together, and we immerse you in what is ostensibly a theatre set. So heavily themed, might be a submarine, it might be Alice in Wonderland, it could be all manner of different themes. So we immerse you in our world, and you have to work together as a team to solve clues, find solutions, and ultimately escape the room, if you like. So it's we'll talk a little bit about its journey as we go further into the presentation. In terms of Boom Battle Bar, this is a much newer business for us. We set this business up at the back end of COVID, and again, we'll talk a little bit about its journey. But ostensibly, it's in competitive socialising. So this is a large format bar business with game. So you come to our venues, they might be 10,000 square feet. We'll have, obviously, lots of bar, lots of cocktail, lots of experience in and around that, DJs playing and so on. But they're anchored by games. So we might have axe throwing, we might have crazy golf, we might have augmented reality darts, a whole suite of different games that we can talk about. So we'll get into the specifics in a moment, but hopefully that gives you a flavour, at least, for what our businesses do. So if we start off giving you a little bit of an overview of the results that we've just been talking about actually with our investor base more broadly. We published 15-month results to March of this year, and we've literally just come off an investor roadshow talking about those numbers. And really the key theme here is one of quite significant growth in a very short period of time. So what you're seeing is quite a aggressive increase in revenue. You're seeing £57 million worth of revenue generated as a business, up from circa 23 in, albeit I might just say, the 12 months counterfactual. So I say this, we're reporting on a 15-month period because we've changed our year end to March. But in round numbers, you can sort of see the direction of travel. So circa £22 million, 23 million up to 57. And I think really excitingly, we're seeing that flow through all the key P&L items. So seeing pre-IFRS 16 EBITDA, so my sort of old school EBITDA, if you like, £6.3 million up from 2.6. So this growth has really been quite evident in both brands. And when you get behind some of the drivers of that, really, this is where we're playing. So this has been a key focus for us, driving like-for-like sales growth. So that is the same store sales growth year on year. And I think you can see in both businesses, Escape Hunt and Boom, that like-for-like growth has been quite extraordinary. So seeing 17% in round numbers on Escape Hunt and 22 on Boom, which I might add is entirely volume-driven like-for-like. We've taken no price in 3 years. So to have that in context, when you think about national living wage going up by 10%, you think about the utilities crisis, you think about supply chain costs increasing. We've absorbed all of that in order to hold prices constant for our customers over the 3-year period. And yet, nonetheless, that investment, if you like, in our customers has yielded this really quite substantial volume-led like-for-like growth. We're very proud of this number here. We are the highest rated customer business in our leisure space of all companies that report. So on the aggregator sites, everybody's TripAdvisor scores, Google scores, Facebook reviews all get aggregated, and our two businesses sit number 1 and number 2 and have done since they were born. So it's a very, very exciting place for us to play, and we firmly believe that if you get it right for customers and you put the sole focus that you can through that customer lens, the economics should follow, but you never chase economics. You allow those to be the byproduct of doing the right thing for customers first. In terms of our scale, I think we've touched on this already briefly, but you can see we have a model that splits sites between owned and operated and franchised. So on the escape hunt side, we've actually just opened another site since this was put together, but circa now 24 sites owned and operated for escape hunt. You're seeing, as I say, about the same number of franchise sites internationally. And on Boom, you're seeing 19 owned sites, or at least you were to this period. We've actually bought some back latterly, so that balance is, has slightly shifted. But in round numbers, 30 sites here in the UK, one in Dubai. And that, as I say, is a business that's grown very, very quickly, but we'll talk to that in a moment. In terms of a few of the specifics around escape hunts, we're really proud of this business. We've grown this business since 2018, when it was this fledgling idea on a blank piece of paper. And to see now some of the box economics that this business demonstrates, I think gives us real confidence for where we can go and where we can take this. We've already talked about the 17% like-for-like sales growth that we've seen overall. But I think really interestingly within that number, if you take the oldest cohort of 7 sites, which we opened back in 2018, which I might add have had no reinvestment from a capital perspective, no new games, they're still playing the same games as they played back in 2018, they too grew at the same level of like-for-like growth. So that's a really interesting place for us to be playing. I think it talks to just how the market is moving in our favour. I think it talks to a lot of the work that we've done to present Escape Hunt as the absolute standout player in this space and turn this previously quite niche-y activity into very much a mainstay of the leisure market. We generate really strong cash out of this business. 42% EBITDA is obviously, I think, by any metric, a great place to be. And I would stress that this is we always talk in pre-IFRS 16 terms, i.e. we take the full property cost through our P&Ls into that number. We don't strip it out, as of course you're now obliged to do for IFRS. So this is 42% proper cash EBITDA, if you like, from these businesses. We've already talked about the fact it's a very well-reviewed business at 99%, but ostensibly it's grown very quickly. The box economics are fantastic. We sit absolutely at the top of the tree in terms of customer review, and we're very excited about the runway for this business, which we can talk about in a little while. In terms of Boom, I said this is a business that's much newer for us. Really, this was born of the back end of COVID. We'd gone through a couple of years of kind of fighting, if you like, fighting to stay alive, tiny business going into COVID. How do you survive? How do you fund it? We were massively subscale back end of 2019, 2020. We were only a couple of years old. And Boom was born of seeing this opportunity for large format space that had never been so inexpensive. If you look to the sort of the trailing 5 years of rental returns, all of a sudden there was an opportunity to get into a lot of space very, very inexpensively. And the reason that's important is, of course, you're signing leases for 10 to 15 years. So that's not a one-time benefit, that's a perpetuity benefit over the lifetime. So we found a company that had done a very good job of putting together these kind of some lease deals, and it had this tiny weeny fledgling business called Boom. At the time when we got involved with it, only had one trading site. We bought that, capitalised it, and have grown it really aggressively between then and now. And as I say, to go from nothing to the 30 sites that we have is, I think, testament to the team who are under an awful lot of stress. It's really exciting for us to see that the metrics are starting to go in exactly the direction that we'd want them to. We target 20 to 22% EBITDA for this business into the midterm. So seeing already that we're up at 17% on the 15 months just gone, I think is a really good sign that we're moving in the right direction. That number is going to be diluted by new sites, which of course you expect to lose money before they make it. So I hope it gives you a flavour for the way that those economics are nudging up. Again, very highly reviewed business by our customers. This is where we obsess, just trying to be better and better, delivering more and more for our customers. But ostensibly a really exciting business, growing very quickly, great cash generation from this business, and we think an exciting place to play. We thought it was really interesting to talk about the return on capital for both brands. Starting first with Escape Hunt. And this is only ordered by sort of high return to low, if you like. But the key point here is that Escape Hunt is still delivering return on capital of 48%. And so, and when we talk about that return on capital, we're talking about, again, this EBITDA in the last 12 months, including the property costs having been deducted, over the cost to build. And we've seen some really interesting dynamics here. So firstly, anything in and around 50%, I would suggest, is clearly market leading. But moreover, we've got this really perverse dynamic in Escape Hunt, where if you were to order this by order of most recent sites built, it would almost be the inverse of this chart, i.e. the sites that we build today are returning their capital much quicker than the sites that we used to build. And that's for a couple of reasons. As we've become a much better established business, as landlords have started to get to know us, as we have shown now for 6 years that we can deliver a really clean, good, well-run operation, we're able to attract much better, higher quality sites that just trade better. So our sales are quite significantly higher than we ever thought they would be. You know, when we set this business up, Nirvana would have looked like getting to £500,000 of sales per Escape Hunt. We're now at 650,000. In terms of the EBITDA, we would have hoped to have got to £150,000, so 30% on that 500. Actually, we're now at 42% on the 650. So all of a sudden, the economics are just a lot better. But moreover, the cost to build has come down quite substantially as well. Our first sites cost us £750,800. We now build them modularly. That's much easier, much quicker, and the cost to build is more 500, 550. So you've got a numerator and a denominator benefit. And as you can see, the return on capital has been quite extraordinary in that business. As you move through to Boom and you see similar things, it's a much younger business, and so I actually expect to see this return on capital improve as the sites mature and they get the benefit of these compounding like-for-like sales. But nonetheless, you're still showing a business which, again, in round numbers, is returning its capital on average at 50%. So it's a very, very well cash-generative business. And what I would say, what that doesn't include is the fact that actually many of our units have a rent-free period too. So, you know, technically cash on cash is better than this, but we just, you know, account for that cash benefit as if we were paying the rent. So in essence, it's ever so slightly diluted, but nonetheless, both businesses at around 50% return on capital is a nice place to play. We just thought it might be interesting just to talk to a few of the growth initiatives that we've put in place, just to give you a little bit of a flavour for the way we think as a business. What this chart here is doing, it's showing one of our units in Oxford. It's an Escape Hunt unit in Oxford. And I guess it's a bit of a first world challenge that we've had, which is that we can see quite demonstrable latent demand in this site. And the way that we're able to show that is to say, you know, clearly on a Saturday we can see that we're fully booked. And on a Tuesday we're not. So if we look at the demand profile when we're not fully booked, ostensibly that orange curve, and we overlay that against time periods when we are entirely sold out on space, then this white space that generates is a decent theoretical proxy for your latent demand. So a pricing consultant would come in and say, well, look, clearly you've got an opportunity to raise price here. Probably true, but we haven't wanted to do that. We've wanted to try and hold price, honour that for customers, and try and come at it the other way, which is to increase capacity. So what we've been able to do in a number of these sites over the last year, and in fact we spent, you know, circa £2 and a bit million on this, is creating additional capacity within these sites. And where we've done that, so Oxford would be a good case, where we've been able to add another couple of rooms, you've seen immediately that demand is starting to fill into that theoretical gap. Thus, I think reinforcing the fact there's a lot more demand out there that perhaps that we recognise. You know, we talk about this aspiration to get to 50 sites in the UK. You kind of look at this and this kind of analysis and you probably think, well, actually that nudges the runway somewhat further north. In terms of Boom, we've done some very similar kinds of work. You know, one of the exam questions for us is, you know, the extent to which we've got 2 axe lanes and 4 darts lanes and we're constrained by our supply of games. Is it better to put in a 3rd axe lane or a 4th darts lane or a 5th darts lane? So this work is just an example of showing how the marginal rate of incremental revenue kind of works by games incidence. And so I only use it as an example to show that actually we're more and more becoming far better data-led as a business. Obviously, everybody starts with a gut feel. Now we're in this fortunate position where we've got analysis to back it up. We can start to make better informed decisions, and indeed all of these things are bolstering economics. This is probably not worth dwelling on this particularly, other than to say that one of the things we've done for Boom is, and you may have read about this if you saw any of our reports, we've bought back quite a number of our franchise sites. We are ostensibly an owned and operated business that has an inherited position with some franchise sites. So we've bought a lot of those back now, and we'll continue to do so. There are a number of strategic reasons to want to do it. I probably won't bore you with those right now, but it is interesting to see that at the point when we buy them back, we're starting to see performance improve, etc. So bearing in mind, when we buy them, we're getting our franchisees typically to fund them, and moreover, i.e. they're paid back out of the cash flow that the sites generate, and we're seeing these kickers. It's a really nice, attractive place for us to be. I think with that as given, hopefully it gives you a flavour for some of the key numbers in the business, but Graham might like to dive a little bit further into some of the financials.
Thank you. Thanks, Richard. I won't dwell on the numbers in too much detail, but I think just to reiterate some of the points that Richard has made. We've got a fantastic business which has grown incredibly over the last 3 years. It's really come from what was a fledgling business into something which is now of decent scale. I think there is a huge opportunity to continue growing that and leverage the fixed cost base that we have at the centre, and we've got plans to do that. So just talking to the P&L quickly, in the financial performance, Richard mentioned we did £57 million of turnover in the 15 months, up very, very significantly on the previous full year in 2022 at 22 million. And even for the 12 months, you're talking about roughly £48 million of turnover, so a substantial increase, more than 100% growth on the turnover in 2022. That split very strong revenue growth in Boom, which was really born of a big rollout of sites in 2022. If you have sort of followed it, we opened, I think it was 21 Boom sites in 2022 and five Escape Hunt sites. So a lot of that growth came from new sites coming through, but that like-for-like growth that underpinned all of that was very substantial too, which gave us that momentum into 2023. Gross margins obviously is a key driving factor for profitability within Boom. We've seen a significant increase there from 52% to 59%. That's born really of two things. One is obviously a bit of scale increase, and we're getting the like-for-like growth, which creates some operating leverage on your labour cost, which is sitting in your cost of sale, your variable labour cost. But also, we spent quite a lot of time and effort last year on improving our systems in the site. When we took on this business, it really had an entry-level sort of EPOS system and stock control system. We upgraded all of that, and we're now seeing very consistent gross margins across the piece, and that's been a significant boost to the profitability of the business. Escape Hunt EBITDA margins at 42% really are industry-leading, and we're getting very, very strong cash flow from those sites now too. So that gave us an adjusted EBITDA of 6.3 million, which was modestly ahead of where the city was for the period. I think just moving on to the cash flow, I think this is really the feature of the business. It's quite difficult when you're reporting under IFRS. There's a lot of noise in the P&L trying to get to the bottom line, a lot of which is non-cash, particularly through IFRS 16, for example. We are penalised quite heavily for being a young business. Number one, we have to use a very high interest rate that we capitalise our leases on, because we're a young business. We hadn't got any borrowing, so we're using an interest rate of nearly 12%. On your leases, which goes through your P&L. It's not cash, it's just it's a notional interest charge, which is knocking our P&L. We also, of course, because all the leases are new, you're at the beginning of the leases, they will have at their highest number, so you've got a very high interest charge on a big number. Over the period, that comes down. Interestingly, if we'd accounted for under UK GAAP, where you just take the actual rent charge as a straight line over the period of the lease, we would have reported £1 million after-tax profit rather than a £500,000 after-tax loss. So it just shows the extent to which some of those sort of that noise can be lost in the P&L. So really, I think the much more important thing is to focus on cash and what is the business delivering. You can see that again, under IFRS 16, you're showing 11.1 million of cash generated from operating activities, but down here you'll see the IFRS 16. Those are rental payments, so 3.1 million of rental payments. So the underlying cash generation from the operations was £8 million. That plays against the 6.3 million of EBITDA. So we're generating more cash than EBITDA. There are two reasons for that. One is we do have some rent-free periods. There's about £900,000 in there, which we benefited in the year, so that will dissipate. But fundamentally, we are a negative working capital business. So the more we grow, we actually generate cash. Our customers pay us in advance when they book their games. We pay our suppliers in arrears, and we don't really hold any stock. So as the business grows, you will tend to generate a little bit more cash than that. So the real question is, if that was your EBITDA, what comes below EBITDA? It's depreciation. So the big question is, well, what's the maintenance CapEx like? If you stopped growing, how much CapEx would we actually spend? In the year, we spent 8.3 million of CapEx. Of that, 1.1 million is what I would describe as a maintenance CapEx. That's probably a bit lower than the run rate because we're still quite a new business, and so we're not necessarily going back into the sites. But we've done quite a lot of work around it, and I think if we were investing 3% of sales on a maintenance CapEx base, that's quite a good estimate of where we would be. So that would say 1.8 million of CapEx on a run rate. As I say, in the last year, we only spent 1 million on maintenance CapEx, but let's assume we spend 1.8. You can then see that the underlying cash profitability of the business pre-tax would have been that 8 million minus 1.8, let's call it 2 million. That's about 6 million pounds of free cash generated, which we could then go and invest. We've got 20 million pounds of tax losses, so there's no tax to pay for a while. But you can make your own assumptions about that, so there's a value in that. So this is a very, very cash-generative business. It's creating very strong return on investment for us. Richard talked to the 50% return on investment we're getting on new sites. So we ought to be able to compound up quite quickly by just taking that operating cash flow, reinvesting in the business that we have. So I think that probably covers the main thing on the cash flow. I won't dwell on the balance sheet. Other than to say that we have got sorry, this seems to have slipped up slightly, but anyway. We've got a little bit of debt on the balance sheet, but net cash of 100,000 at the end of the year. That debt, most of it, or about half of it, I should say, is vendor loans. There's some fit-out finance, which we've taken, which are really quite a lot of our equipment is effectively on hire purchase, and just the way you have to account for it, you've got to gross it up and show it as debt. But I think the real news is that we've just had full credit approval for a £10 million revolving credit facility from our bank, Barclays, which I think really is a huge endorsement to the maturity of the business and how far we've come in 3 years. It's not our intention to take on lots of debt. I would still anticipate being close to zero net debt, or maybe a little bit of debt as you go through the cycle. But really what this enables us to do is go ahead and sign sites with confidence, because previously by paying for sites out of self-generated cash flow, you actually want to generate the cash before you sign the lease so that you know that you can build it when you get there, which gives a bit of a lag. With the credit facility, it just means we can keep that momentum of signing new sites, finding new sites, and building through the cycle much more effectively. So a significant step for us going forward. I think it also probably means that we can be a little bit more ambitious about how many sites we want to do. Again, because it takes time to find the site, sign it, complete the lease, get it built and open it. With the confidence of having the money there, you can just be a little bit more methodical around that. So I think that probably covers everything I was going to say on the balance sheet and where we'd got to. So perhaps, Richard, if you want to just talk and sort of close off here.
Yes, so I guess if I were to conclude just before taking any questions, I suppose the points I'd like you to kind of take away with you today are, firstly, I think we've shown now quite demonstrably that we're a very, very fast-growing business. We've literally doubled for the last 3 years, compounded. So that's quite an exciting place to play. We've got a team in place that's able to do a lot more than we're doing. That's quite by design, and I think that's one of the reasons that's allowed us to get to where we are. We think there's a real runway to go after. We think there's at least 50 sites for escape hunt in the UK. I think that's going to get nudged up, if I'm honest, as we get more and more of these analytical learnings. There's at least 100 booms in the UK to go after, so we're certainly not shy of runway, and that's before you consider any of the international territories. I think really excitingly now, combined with the organic cash flow that we generate and now this RCF, we are able to fully fund that growth dynamic as well without needing to come back to the market for additional equity. So I think that's hopefully quite a fun place to play. And I think just harking back on one of the points that Graham made, that £5-6 million of free cash generation represents circa 20-25% free cash yield. So that is, I would suggest, a very interesting place to be for our kind of a business. So hopefully that's a decent enough summary of XP Factory, but we'd love to ask for any questions.
Thank you, Graham. Thank you, Richard. Just raise your hand and then we'll take you one at a time.
Thanks. Yeah, franchising, is that increasingly your way of expansion? And I wondered how you see that working out. Do you have franchises where you would retain ownership of the premises and the plant, but you're actually looking for someone to come in as an operator, or would you be looking for enterprising folks like in this room to come and actually do the whole thing for a license fee?
So where we have franchises, they are the latter. So they are enterprising individuals that have made some money, want to run a business, and have come, basically bought from us the IP, the platform, the booking engines, the support, etc., etc. We don't own any of the properties. We lease all the properties. So we would never have an owned property that we let. I think strategically, at least in the short term, we're actually moving a little away from franchising towards owner operation. And the reason for that, I guess, is a couple of, it's probably twofold at least. One is that when you're returning at 50% on your own capital, to be honest, you just want to roll more of it out. And two is that we feel that if we were to unlock franchising at a much greater scale at some point further down the line, the exam question becomes, how do you attract the individual or group of individuals that can deploy proper capital and actually end up with 10, 15 sites rather than 1 or 2? Because those are the sorts of partners that are perhaps a little bit more interesting to work with strategically rather than tactically. So at the moment, you're going to see us more likely bring some of the franchises back in-house in order to normalise that platform a little bit, to give ourselves the option further down the line, maybe just to keep on doing what we do and, God willing, return the capital at that rate, or hopefully be a little bit more attractive to the slightly bigger franchise partners.
Hey, gentleman there. Oh, you going over there?
You explained on Escape Hunt how the sites have a lot of longevity, and you're saying 2018 sites are still performing really well. Or obviously your experience is less on the Boom Battle Bar, but what's your expectation on the sort of the life before you'd need to do a total refresh of the site, and how much does it cost to build out a Boom Battle site?
So you're right, I never actually touched on that, which is a little embarrassing. So first things first, so a Boom Battle Bar is typically around £1 million to build, but historically we've received £400,000 on average of capital contribution. So our net in, if you like, has historically been somewhere between £500,000 and £600,000 on a boom, which is again where you see that return on capital coming from. You know, we talk about that 50% return on capital, and that's obviously equating to the circa £300,000 of average EBITDA that you would expect to do. You're absolutely right. We've not had that business for long enough to fully appreciate what the reinvestment cycle is going to need to be, albeit the games by design are entirely modular. So bringing games in and out is a very easy and relatively inexpensive thing to do. The thing that costs a lot of money when you build a site like a Boom is getting the infrastructure in place. It's the M&E, it's the air conditioning, it's the bars, it's the back of house. Well, that stuff's kind of there to stay. Yes, it's being maintained, but we're expensing that through the P&L. In terms of the capital charges involved with replacing games, it's not that much money. We're assuming that at the point when we get into a sort of full maintenance cycle, it'll be circa £50,000 per site per annum. That, you know, so the overarching maintenance assumption that Graham talked to equates to around about 3% of sales. And so if you did the maths on, you know, if you take the fact you got net £600,000 in a Boom, and let's say £300,000 of EBITDA, and we provide 50 for maintenance, you're still at 250 over 600. So your return on capital is still in a really, really good place.
Hi. Looking at your financial position summary, is it true that your total debt is 3.858 million at the moment?
Do you want to answer that? Yeah. Yes. So we had 3.9 million pound of cash, and 3.8 million pound of debt on the balance sheet. So that's the net cash of 100,000.
Interest you have to pay on that debt?
It varies because some of that is the vendor loans is effectively deferred consideration on the buyback of franchise sites, where we're paying an average of 5%.
Is it worth talking through how that works?
Yeah, I mean, typically how we've done it in the past is with those franchise acquisitions, we pay a small amount of money up front. And in fact, if you look in the cash flow statement, we bought back 1, 2, 3, 4, 5 sites last year, and that cost us a net £50,000 in actual cash. The rest is financed really from deferred consideration, which we effectively pay from the cash flow of the site itself. So we work it out. We know that we can make 50% return on capital. So it's balancing buying these franchise sites back. We're looking for a very, very aggressive payback because it needs to stack up with the alternative use of cash. And typically we're looking to pay for those from the cash flow from the site itself. So yes, on that 1.1 million, we're paying an average of about 5%. So it'll be a little bit lower than that. This is a couple on 0%. The finance leases and fit-out finance is a mix because it's hire purchase. It can be anything from about 11 to 15% on a proper compounded basis. The AER, they'll quote you, will be 10%. But when you do the real workout, you know it's a bit more than that. And then on the bank and other borrowings, there is a loan we have with a high net worth individual, which is at the same sort of rate we would get a bank loan. We've actually.
I ask you this, that you want, of course, expand your business. And how much you think, if a bank would give you that money, how much you would like to have from the bank in order to expand your business?
We've just received a £10 million credit facility from Barclays. They're prepared to offer quite a lot more. We don't want to take it. Yeah. So we think it's a very important thing to manage quite astutely the net debt position. We're not a private equity business. We don't need to be over-leveraged. But having this facility in place for £10 million allows us to do exactly what we need to do and quite a lot more, if I'm honest.
Okay. Yeah. Thank you. Thank you very much.
Could I ask, what proportion of the people that do escape hunt come back and do it again and again? And what's the average age of the people that do that?
Sure.
And also, is there much crossover between the people that play escape hunt and the boom?
Yeah, absolutely. If I take those, if you don't mind, ever so slightly out of order. So the distribution, it's kind of the age distribution for both businesses is actually quite flat, like remarkably flat. Both businesses do over-index as you might imagine, the 25 to 35-year-old group. They're circa 40% of the customers actually for both. If on an associated point, escape hunt index is ever so slightly female, sort of 52-48, and boom is male in the same proportions, but very, very sort of straight down the middle pretty much. And it's really nice, particularly on escape hunt, seeing these broad tails. One of the selling points of escape hunt from a customer perspective is it's genuinely a thing that you can do together, cross-generationally, etc. So actually, if you're grandparents with grandchildren, you typically go and watch your grandkids play football or cricket or netball or whatever it might be. Well, this is a thing you can actually do together. So that's been quite lovely. We probably didn't see that coming when we set it up, but it's been a really lovely facet of the business. But that is your over-indexed demographic. In terms of how many times people come back, I'm going to preface this with the fact that our data on this is pretty soft. And the reason it's soft is that if you book as a group of 4, our true reference point is going to be the email addresses of the people that are booking. But if you in your group of 4, somebody books this time, somebody else books next time, we're hopefully going to pick that up through waivers, but it is a slightly soft data point, just to be really clear. But we think that it's about 2.1 times per annum. So against a site that has 6 different games rooms within it, typically a customer has got sort of 3 years to cycle through them. In terms of the cross-population or fertilisation, if you like, between boom and escape hunt, where that is at its most evident, we do actually have some sites which have both businesses within them. So near to here, Oxford Street would be a really good example, where we've got a massive great boom and then an escape hunt right at the back. And it is incredibly common for escape hunt customers to come out, have a drink at the bar, hopefully they're going to get upsold some shuffleboarding or whatever it might be. So you see that a lot.
Do I have to switch this on? I was just sort of 3 independent questions. Could you give us some idea of what your revenue mix is between sort of booking costs, food and beverage, and the trends there? That's point 1. Point 2, is it still efficient to go down the leasehold route? I don't know whether you have any freeholds, but I think your flavour was...
No freeholds.
And thirdly, the pub industry has been throwing out lots of square footage over the last year or so. Has that thrown up some interesting opportunities for you, sort of in the right locations?
Yeah, sure. So taking those in order, in terms of the two brands, the revenue mix for Escape Hunt is really, really easy. It's almost all game. So we have no food, we have a tiny amount of drink, but that is literally a small fridge, couple of bottles of wine, few bottles of beer, etc. 5% of sales max, 95% games revenue. So Escape Hunt is very, very straightforward. Boom obviously is pretty heavily wet. So we're about 60% wet, 55% wet probably, 5% food, and 40% in game. So that sort of split. It does vary a little bit by site, but that gives you a good flavour for it. In terms of the leases, we have no freeholds, and we still think that leases are in a really attractive place. I mean, how do I qualify that? I qualify that by the types of deals that we're getting. So it is not at all uncommon, particularly on the boom side, where the larger spaces are typically less popular. Escape Hunt's 3,000 square foot. That's going to have more competition from retail, small restaurants, large there's more competition for that space. 10,000 square feet, there aren't so many operators. And so typically we're seeing what we would refer to as 3 to 4 year deals. That is to say, if I'm paying £100,000 of rent in a year, I'm probably getting £400,000 of benefit up front from the landlord. That might be split £200,000 of capital, 2 years of rent free, but something in and around a 3 to 4 year deal. That's a really good place to play. The market wasn't like that pre-COVID, so we still think leases are certainly an interesting place for us to be. Yeah, and then to your point about pubs throwing out thousands of square feet. I mean, sadly, I think there's a bit of I think it's not just pubs, it's bar. I mean, even this morning, TGI's went pop this morning. Unsurprisingly, we're straight on the phone. Bunch of sites we quite like. You feel a bit like a vulture. But sadly, it is the nature of the business. I think we're in a very fortunate place where we are in a space that customers like. We are in the space that customers want to be doing a thing. And whilst it's obviously sad and nobody wants anybody in the industry to be sort of suffering, it is possibly slightly to our advantage that there are a lot of sites coming up.
One more question and then we're going to have to move on, I'm afraid.
Could you give us an idea of what your aspirations are for EBITDA margin at a group level? Because presumably you should see some operating leverage now going forward.
Yes, I've just got to do the maths on that. So, sorry, we think about it more in terms of boxes, less head office. I'm just doing the maths on the fly. But I don't think you'll expect to see more than... We certainly shouldn't expect to see more than 40% coming out of the boxes at Escape Hunt. So in round numbers, if we do £15 million in Escape Hunt at 40%, so then you're at £6 million there. I think Boom, we would expect to get to like blended 20, 22, 23, something in that sort of ballpark. So if you assume very little sales growth and you're at £45 million on that business in round numbers, then at your 20% to make the maths easy, that's another 9. So then we're at 15. We've got a couple of million in franchise fees which are coming through, so then we're at 17, and we've got a head office which last year was annualised at £8 million. So then if you take that off, so then you're at 9 over 62 would be a place to start kind of over time. Now we've got to build into that, but I think that wouldn't be an unfair representation. The key point is that the head office has been well enough built out now that it is definitely getting well leveraged against the growth. It's not true to say that there will be no more hires. You want to maintain strong ratios of area managers with new sites that are being opened. I think it's really important to kind of keep that customer in the crosshairs and offering the best service, and having investment in that is a smart place to play. But we don't have many other big hires to bring into the head office. We're probably a little shy on HR. That might be a big hire that we make at some, I say big hire in very relative terms, but ostensibly by far the bulk of the head office is already there, and so it will get well leveraged whilst also growing slowly.
Okay, thank you. It looks like we've got a few more questions for you. I hope you'll be able to stay with us for the drinks and stuff afterwards, because you might get grilled. So,
love it.
So thank you very much.
Thank you so much for your time. Really appreciate it.
Thanks, Greg.